Altcoins are pumping. Ethereum just had its biggest ETF inflow day ever. Bitcoin dominance is dropping fast. But here's the strange part. Retail still isn't really here. Yes, search interest for quote altcoins is climbing again, but on-chain volumes are quiet. Meme coin activity is quite muted, and YouTube views are flat. Crypto Twitter is still debating chart patterns and waiting for influencers to tell them what's next. So, what's actually driving this rally? The answer isn't hype. It's something much, much bigger. Behind the scenes, Wall Street has quietly deployed billions into Ethereum and is now expanding that same playbook across the rest of the market. Treasury companies, regulatory clarity, and a brand new capital structure are fueling the start of a very different kind of altcoin season. My name is Danilo, and today we're breaking down exactly how that's happening, what it means, and where the smart money is heading next. If that sounds interesting to you, make sure to hit that subscribe button and ring the notification bell so you never miss future crypto updates. Alright, let's get into it. When most people think of altcoin seasons, they picture influencers shilling meme coins, TikToks hyping the next 100x, and retail traders blindly chasing what's trending on Twitter. That's what we've been conditioned to expect. A loud retail-fueled frenzy that signals the start of a true alt season. But that's not what's happening right now. Retail sentiment is still quite lukewarm. Trading volumes are quiet, new wallets aren't flooding in, and yet altcoins are grinding higher, in some cases very aggressively. Tokens like Eigenlayer or Pendle have quietly climbed double digits over the past few weeks, even as search interest and Telegram activity stayed flat. That's structured buying at play instead of the usual hype. The typical retail signals just aren't showing up, so naturally most people are confused. They're sitting on the sidelines waiting for fireworks, completely missing the fact that the alt season has already started, just with a different cast and a different playbook. This cycle isn't being driven by memes or influencer hype. It's being driven by structured capital, the kind that moves quietly, deploys with intention, and doesn't care about your TikTok trends. Institutional buyers have started entering this market in a very real way. And when that happens, it doesn't look like the mania people are used to. It looks slow, strategic, and boring, until suddenly everything is up 50%. That's why everyone got this wrong, because they were looking for the wrong signals. And if you can recognize that shift before the crowd catches on, you're not just early, you're positioned ahead of the next real wave of capital. So what exactly is driving this early strength in altcoins, if not retail? The answer lies in something most people don't even know exists: Treasury Flywheels. These are public or semi-public companies raising money through equity or debt, and then deploying that capital directly into crypto assets like Ethereum, Solana, and other altcoins. Not as a side bet, as their core business model. Here's how the flywheel works. A team announces a new company. Maybe it's, quote, building infrastructure for decentralized AI, or some vague blockchain narrative. They raise millions in equity funding. Then, instead of spending it all on development, they convert a big chunk of it into ETH or SOL and hold it on the balance sheet. That ETH exposure gets priced into their share price. If the market's bullish, their equity trades at a premium to NAV. And that premium makes it easier to raise more capital, repeat the process, and pump their token treasury even higher. This structure is attractive because it offers leveraged upside through the equity markets, letting these teams accumulate tokens without launching one themselves, and without relying on crypto native retail. It's a capital formation strategy disguised as a startup. You might have seen this model quietly gain traction already. Bitwise holds almost 130k ETH. EtherFi spun out a treasury company. Franklin Templeton and others are talking openly about token exposure in managed portfolios. It's no longer just about buying tokens, it's about building financial structures around them that can attract outside capital and create self-reinforcing demand. What makes this different from past cycles is that it's not relying on hype. These aren't degens flipping JPEGs, they're financial entities bootstrapping real exposure through legal, scalable, and repeatable structures. And the more ETH they hold, the more valuable their business becomes, which means they go back and buy even more. That's the flywheel, and once it's in motion, it doesn't really need retail. It can run on capital markets alone. Now, you might be thinking, haven't we seen this before? Didn't MicroStrategy do this with Bitcoin in 2020? Didn't, quote, treasury narratives already play out? Well, sort of, but this time is completely different, and it comes down to regulatory clarity, market structure, and scale. First, the regulatory environment has shifted. Just a few days ago, the Genius Act was signed into law. It legally recognizes stablecoins and gives explicit support to compliant DeFi activity. That might sound boring on the surface, but it unlocks something massive: institutional comfort. companies can now hold ETH, stake it, and access yield, and do it all without fear of a legal crackdown. That just wasn't possible in 2020. In fact, even as recently as 2022, staking ETH as a corporate entity meant navigating murky tax codes, potential SEC scrutiny, and vague legal opinions. Today, that has flipped. We now have clear guidance, compliant staking infrastructure, and ETF wrappers, all of which allows firms to allocate with confidence. Second, we now have ETF infrastructure. Spot ETH ETFs are live. They're pulling in hundreds of millions per day, over 2 billion in inflows year to date. On July 17th alone, ETH ETFs brought in more than 700 million in a single day. That kind of access didn't exist before. It's no longer about figuring out how to buy crypto. It's a ticker symbol away for institutions, pensions, and treasury allocators. And finally, there's the scale. This isn't just one company like MicroStrategy. It's a growing set of entities, both crypto native and traditional, who are building token-backed financial structures with serious capital. Some are public, some are private, but together they represent a massive new demand base that simply didn't exist in the last cycle. So yeah, we've seen hints of this before, but the pieces weren't all in place. Now they are. And that's why this isn't just another hype wave. It's a structural shift in how crypto assets get adopted at scale. While everyone was distracted by meme coins and influencers arguing about Bitcoin dominance, Ethereum quietly became the real institutional entry point. You wouldn't know it from social media, but the numbers speak for themselves. In 2024, most ETF inflows went to Bitcoin, but this year, that narrative flipped. Ethereum has already pulled in over 2 billion in ETF inflows with a single day spike of 700 million in just this past week. That number surpassed every Bitcoin ETF on the exact same day. And keep in mind, it's not just the ETFs. On the CME Futures Exchange, Ethereum Open Interest recently flipped Bitcoin. That's the institutional playground, the hedge funds, the asset managers, and treasury desks. If they're choosing ETH over Bitcoin in their trading strategies, that's a clear signal that Ethereum is now seen as the more programmable, yield-generating, and flexible asset. But here's the part no one's actually talking about. ETH is no longer just a bet on Ethereum. It's become a gateway to everything downstream. L2s like Arbitrum and Base, staking platforms like EigenLayer, and altcoins that follow ETH's lead in terms of capital flow. So when these treasuries buy ETH, they're not just speculating, they're positioning for broader ecosystem exposure. This is what makes the flippening so quiet. It's not about the headlines, it's about capital infrastructure shifting underneath the surface. ETH is becoming the reserve asset for this next wave, and that has implications way beyond just its own price. Once ETH becomes the starting point, everything downstream starts to move. And that's exactly what we're seeing now. Once these treasury and fund structures buy ETH, either directly or through ETFs, the natural next step is to rotate into ETH adjacent assets. That includes layer 2s like Arbitrum, Optimism, and Base. It includes restaking protocols like EigenLayer, and it also includes altcoins that are deeply tied to ETH liquidity, whether it's through staking, lending, or DeFi infrastructure. We're already seeing it play out. Arbitrum and EigenLayer have outperformed the market in recent weeks. Token flywheels are forming around these ecosystems, and capital is flowing in without waiting for retail confirmation. This shift isn't just limited to Ethereum's orbit either. Solana, which had no institutional legitimacy just a year ago, now has a pending spot ETF application from VanEck and is being openly discussed by US asset managers. Treasury-backed entities are popping up with SOL exposure on their books. Capital allocators are looking beyond Bitcoin and ETH. They want yield, ecosystem exposure, and products that offer upside beyond just store of value narratives. And here's the key insight. These rotations are happening earlier and faster than they did in previous cycles. Back then, ETH had to double before alts even moved. Today, some of these assets are front-running ETH. That's a clear sign that institutional flows aren't just stopping at Ethereum. They're spreading methodically across the rest of the crypto stack. So now that you know what's happening, the obvious question is, what can you actually do about it? The first step is to shift your mindset from chasing hype to tracking flows. If you're waiting for influencers to tell you when altcoin season starts, you're already late. The smart money is deploying into assets with structural demand and not just social buzz. That means paying attention to treasuries, ETFs, and ecosystem expansions, especially the ones that don't make the headlines. Second, start looking at ETH as an upstream asset. It's not just a trade, it's the first domino. If ETH is pulling in capital from ETFs, treasury firms, and institutional desks, then the protocols and tokens downstream from ETH, like Eigenlayer, L2s, and Ethereum aligned altcoins are likely next in line. Third, don't ignore Solana and other growing ecosystems. The VanEck Solana ETF filing plus the emergence of treasury-backed SOL holders shows that capital rotation is real. Look for ecosystems with clear capital access, growing developer activity, and token exposure that institutional players can justify. And finally, stay ahead of the curve by following infrastructure, not influencers. If a project is building tools that institutions need, whether that's staking platforms, restaking, or tokenized treasuries, that's a good chance they'll benefit from this new capital structure. These aren't narrative trades, they're capital formation trades. If you want to track what really matters, don't just follow social sentiment. Watch ETF inflows, look at treasury filings, follow smart contract wallet activity. That's where the signals really are. This cycle might look unfamiliar, but that's exactly why it matters. Instead of chasing hype and waiting for signals from retail, we're entering a phase where capital moves earlier, quieter, and with more intent. For those paying attention, that's not a reason to sit out. It's a window to get positioned before the crowd shows up. The key is learning to follow the flows and not the noise. Look for projects that are structurally tied to ETH and SOL demand. Watch how treasuries deploy. Track the capital and not the influencers. And if you can do all of this, you won't just survive this new cycle. You'll understand how the next wave of wealth creation is likely to unfold. I'm curious, what altcoin or ecosystem do you think is flying under the radar right now? Drop a comment and share your take. And if you found this video helpful, hit that like button and subscribe for more sharp, research-backed crypto breakdowns. Thanks for watching, and I'll see you in the next one.